In 2010, you could buy Bitcoin for 8 cents. Amazon was $130 a share. Tesla was trading at $3.40 after the split adjustment. Everyone who invested back then was called crazy. Everyone who didn't wishes they had. The pattern repeats every single cycle. The best investments of the next decade look obvious in hindsight. But right now, today, they look uncertain. Risky. Too early. That's exactly when you're supposed to get in. Here are 5 investments positioned to explode in 2026, and one of them requires zero risk at all. Everyone's talking about AI. ChatGPT. Copilot. Claude. Midjourney. Every week there's a new tool that makes your jaw drop. But here's what most people get wrong. They invest in the AI applications. The flashy front-end tools. The companies making chatbots. In the 1849 gold rush, most miners went broke. You know who got rich? The people selling pickaxes and shovels. Levi Strauss didn't mine a single nugget. He sold jeans to miners. He built an empire. The AI gold rush is no different. The real money in AI isn't in the apps. It's in the infrastructure. The chips. The data centers. The cloud computing. The energy to power it all. NVIDIA, ticker NVIDIA, controls roughly 80% of the AI training chip market. Their revenue went from $27 billion in fiscal 2023 to over $130 billion in fiscal 2026. That's not hype. That's a 5-fold increase in actual revenue in 3 years. But NVIDIA isn't the only play. Broadcom, ticker Broadcom, is building custom AI chips for major tech companies. Their AI revenue tripled in 2024. Taiwan Semiconductor, ticker TSMC, manufactures almost every advanced chip on the planet. They are the foundation underneath NVIDIA, Apple, AMD, and everyone else. And then there's the energy angle. AI data centers consume enormous amounts of electricity. Companies like Constellation Energy, ticker CEG, and Vistra, ticker VST, are seeing their stock prices surge as demand for power skyrockets. Now this is where it gets interesting. Goldman Sachs projects that data center power demand will increase 160% by 2030. The International Energy Agency estimates AI alone could consume as much electricity as Japan by 2030. Someone has to supply that power. And the companies doing it are still undervalued relative to the demand curve ahead. Risk level, high. These are individual stocks. They can drop 30% in a bad quarter. But the secular trend to the long-term demand for AI infrastructure is arguably the strongest investment thesis of the decade. If you're going to pick individual stocks, never bet more than you can afford to lose. And diversify across the supply chain and chips, energy, cloud. This is the single most important chart in finance. The S&P 500. 100 years. Through the Great Depression. World War II. The dot-com crash. The 2008 financial crisis. COVID-19. Every single time, it recovered. Every single time, it went higher. The average annual return of the S&P 500 since 1926 is approximately 10.5% before inflation. About 7% after inflation. No stock picker, no hedge fund, no algorithm has consistently beaten this over a 30-year period. Warren Buffett, the greatest investor alive, has said repeatedly that most people should just buy a low-cost S&P 500 index fund. In his will, he's instructed that 90% of his wife's inheritance go into an S&P 500 index fund. If it's good enough for a man worth $130 billion, it's good enough for us. But here's the thing most people miss. The power of the S&P 500 isn't in timing the market. It's in time in the market. Dollar-cost averaging, investing a fixed amount every single month regardless of what the market is doing, eliminates the need to predict anything. If you invested $500 per month into VOO, Vanguard's S&P 500 ETF starting in January 2015, by the end of 2025, your total contributions of $66,000 would have grown to roughly $140,000. You doubled your money. Not by being clever. Not by watching CNBC. By showing up every month and pressing the buy button. VOO. SPY. IVV, FXAX. Pick your flavor. The expense ratios are negligible, as low as 0.03%. You're paying 30 cents per year for every $1,000 invested. This is the foundation of every portfolio. Not the exciting part. The essential part. Everyone knows real estate builds wealth. The problem is that buying a property requires a massive down payment, dealing with tenants, fixing toilets at 2 a.m., and taking on hundreds of thousands in debt. REITs fix all of that. A real estate investment trust lets you invest in real estate the same way you'd buy a stock. You buy shares. You collect dividends. Someone else manages the properties. And here's why REITs are especially compelling right now. Interest rates. The Federal Reserve raised rates aggressively from 2022 to 2024, crushing REIT prices. Many high-quality REITs dropped 30 to 50% from their highs. But as rates begin to stabilize and potentially decline through 2026, REITs historically surge. After every rate hiking cycle in the last 40 years, REITs have outperformed the broader market in the 12 to 24 months following the first rate cut. Some specific names to watch. Realty Income, ticker O, is known as the monthly dividend company. They pay dividends every single month and have increased their dividend for over 100 consecutive quarters. Current yield, roughly 5.5%. Prologis, ticker PLD, owns logistics warehouses. Every time you order something from Amazon, there's a decent chance it passed through a Prologis building. E-commerce isn't slowing down. Neither is their rent collection. VC Properties, ticker VC, owns casinos and experiential properties. The Venetian, Caesars Palace, MGM Grand. People don't stop gambling in a recession. In fact, gaming revenue has been remarkably resilient. And for those who want instant diversification, VNQ, the Vanguard Real Estate ETF, holds over 150 REITs in a single fund with an expense ratio of 0.12%. The beauty of REITs is the income. While you wait for the price to recover, you're collecting dividends. You're getting paid to be patient. Now this is where it gets interesting. Because investment number 4 has literally zero risk. Investment number 4, high-yield savings accounts and treasury bills. I know. Not exciting. But listen. Right now, in early 2026, you can earn 4 to 5% on your money with virtually zero risk. High-yield savings accounts at online banks like Marcus, Ally, or Wealthfront are paying over 4% APY. U.S. Treasury bills backed by the full faith and credit of the United States government are paying similar rates. You can buy them directly from treasurerdirect.gov with as little as $100. This is where your emergency fund should live. This is where money you'll need in the next 1 to 2 years should sit. Not in a checking account earning nothing. Not in the stock market where it could drop 20% right when you need it. It's not glamorous. But free money is free money. Investment number 5, digital assets and online businesses. And I'm not talking about cryptocurrency. I'm talking about businesses. A YouTube channel. A niche blog. A digital product. An email newsletter. A software tool. The cost to start an online business in 2026 is essentially zero. A domain is $12 a year. Hosting is $5 a month. AI tools can help you create content, design graphics, and automate operations. But here's the thing that makes this different from every other investment on this list. Stocks give you returns. Businesses give you control. An S&P 500 index fund might give you 10% a year on your money. A well-built digital business can return 100%, 500%, even 1,000% on your investment because the investment is mostly your time and creativity, not your capital. Empire Flippers, a marketplace for online businesses, reports that established websites and digital businesses sell for 30 to 50 times their monthly profit. That means if you build something that earns $2,000 a month in profit, you've created an asset worth $60,000 to $100,000. From nothing. With almost no startup capital. In a year or two of focused effort. This is the most asymmetric investment on the list. Low capital risk. High time investment. Potentially unlimited returns. 5 investments. 5 different risk levels. 5 different time horizons. But they all share one thing in common. They all require you to start. Not tomorrow. Not when you have more money. Not when the market feels safe. Now. Today. With whatever you have. Because the single biggest mistake in investing isn't buying the wrong stock. It isn't bad timing. It isn't even losing money. It's never starting at all. If you found value in this, drop a like. It tells the algorithm this matters. Subscribe if you want to build real wealth, not chase hype. And next video, we're going to show you exactly how $5 a day, the price of a coffee, can turn into $1 million. The math will change the way you think about money forever. I'll see you there.